I got questions a lot over the years about, how did I used to trade before I could trade with intraday charts and look at data like that. When I first started, how did I start doing it? And what time frames did I use? Because if I couldn't be in front of the charts live, what was it that I did? I used the daily chart because I worked a job, and when I come home in the evening time, I would get off. My route would usually end around, I don't know, it depends. There was one day a week where I would get off at 4 o'clock, but for whatever reason, I would always hang out to the same time. I would normally leave on my regular day and hang out with my then boss, pick his brain and get inspired by him talking about how he made money, this and that thing. But when I first started trading, I was working with him. And I bought this charting software called Metastock. I think you can still get it today, but it was really nice because it would make the charts for you. It had all kinds of indicators and such when I had belief and faith in indicators. But I would look at the daily chart and try to determine where it was going to go up to. I didn't want to short because I didn't believe in it. I didn't have any faith in it. I couldn't understand how I could sell something I don't own, because that's essentially what you're doing when you're shorting. So I avoided doing that. I would only look to be a buyer. And the way I framed it and how I actually started teaching before I should have been teaching, because when I was seeing it work, I thought I figured everything out before I did. And I was on America Online, and I was at the forums and posts, and they called it message boards back then. And I would share what I thought was going to happen in what commodity. And I started posting my opinions about what I think is going to happen. And I never put up a disclaimer because I didn't understand the laws then. I didn't know anything about it. I figured everybody could say whatever they wanted to say, freedom of speech type thing. So I would post my opinions about what I would see. And because I thought that everyone would appreciate me teaching what it is I was doing and how I picked certain markets, I would show them what I was doing. I would look at the daily chart. I think it's going to go up to this level here. And if it's going to go to that level, that means the next few days should start moving in that direction. So how would I time my trade? I would look at a 60-minute chart or hourly chart. And then when that stochastic that I would plot and a 10 period Williams percent R. So I was using two overbought, oversold indicators, not understanding that they both were saying the same thing, because Williams percent R is basically stochastic, because George Lane did not invent stochastic. Everybody in the book say, and he says he invented it, but he didn't. But Williams percent R is basically one part of what a stochastic is, and Larry Williams created the Williams percent R. So when they were both in agreement and they were below the 30 basis line that would be used to determine my buy or sell, if it was oversold, that means for stochastics, it would be like 30% or under. To me, that would be oversold or cheap, okay? What I would do is I would wait for it to go down, go oversold, come up out of the oversold and go back down and again, but price, make a lower low, but the stochastic and RSI, not RSI, Williams percent R, be oversold at this time, but not expect that same low to be blown out with the indicator. So in other words, I'm looking at what was considered a type 1 bullish divergence. A type 2 divergence, which is everybody calls a hidden divergence today, that was actually invented by Nick Van Ice. He was a small-time trader. He ran a company called Commodity Price Charts, and that was the best charting platform there ever was. They beat out CRB, in my opinion. They were just really nice charts, and I wish they were still in business, because even though they're like end-of-day stuff, I still would use them because I loved them. They were just easy on the eye. It was just beautiful. And they were open, high, low, and close bars, not candlesticks. But anyway, Nick Van Ice created and made it public what is referred to, and he called type 2 trend following divergence. But if you look at or Google hidden divergence, he never gets the credit for it. So it's just one more thing that pisses me off about this industry. Like when I teach something that's mine, no one else has done it before, someone else comes along and renames it and they try to get credit for themselves. It's all bullshit. So with looking at a daily chart, expecting it to go higher, how was I determining it was going to go higher? What was the way of determining that? I would look at an 18 and a 40 day moving average. If the 18-day was above the 40-day and they were stacking, that means they were opening up and both of them pointing up together. That was my bias to look for longs. And then what I would look for is just the indicator going down to oversold and creating a bullish divergence. And the missing part of this that I didn't understand, which is the real reason why I was seeing success in the ideas that I was, trying to employ, was the market was extremely bullish anyway. And I didn't understand that. I didn't understand that the monthly and the weekly were already trying to get to objectives that I didn't even notice. So I was correct on my right side of the, and I was using technical indicators that at the time were lining up because I had it correct without knowing I had it correct. In other words, my faith in that system was rooted in the divergence pattern until the markets entered a market where it was going down. So when I entered a bear market, I couldn't make any money. Every single trade I got into was a failure. And I was getting mad. And I would get in and I would do more leverage and not use a stop loss, or open the stop loss when it was going towards where my stop. I would move it bigger, and it would just expand to take the liquidity below a short-term low. Because in my mind, when I first started, I had the same books that you all probably seen already, or have in your Amazon cart ready to buy and haven't pushed the button yet. Don't buy them. I'm gonna tell you something. They're gonna fucking book on Amazon is gonna teach you how to trade profitably. Period. End of story. Don't ask me for a title that tells you to do that, because they don't exist. They all tell you bullshit. They'll get you out there doing the same nonsense. And the books that I bought and subscribed to and listened to the VCR tapes and DVDs when they were starting to come out, they're all telling you to do the same thing. Buy double bottoms, short double tops, look at moving average crossovers. I didn't look at a crossover. The crossover didn't mean shit to me. I want to see something on a daily chart that has sustained movement. And that's what I mean by the 18 and 40-day moving average. Here's a little tip for you that have been staying this long in the video. Okay. If you take a 18-day and a 40-day moving average and apply it to your daily chart, what kind of moving average? I use the exponential moving average. This is going to be like a training wheel for daily bias. Okay. Listen, folks. If you take an 18-day and a 40-day moving average and apply it to a daily chart, after they cross over, like if the 18-day crosses above the 40, and then there's days, not as soon as it crosses over, because that's bullshit. You want to see that the market is already starting to expand and start moving higher. When that occurs, and you can see the draw on liquidity on a weekly chart that's above market price, if the daily chart shows the 18-day and the 40-day moving averages going up together, they're both now pointing the same direction. If there is a fair value gap below price on the daily chart, watch how it goes down and goes into that fair value gap and then runs your objective. Teach me bias. Here's one more instance of it. Every time I talk to you, I'm teaching you bias. There's so many ways to apply daily bias. Are you using daily bias for your intraday trade? Are you using daily bias to get in position for a swing trade or a short-term trade? What are you doing? Because I can use daily bias to do a market reversal profile too, and be in a will be considered bullish market and bias. I could use that bullish bias and then anticipate a market reversal in the same day. That's advanced. And you can't ever understand that until you understand how to subscribe, follow the average daily bias movement. Is it likely to keep going higher, or is it likely to keep going lower? That's all you have to figure out. And then look for setups that go with that. And how I determined that was the best way of doing it, by understanding how I failed initially. Because the success I had initially with buying bullish divergence was the fact that I had an unknown alignment with bias on a higher time frame chart, weekly and monthly. So when I teach my private mentorship group, when we sit down every single week, I'm teaching them to predict the weekly range expansion, higher or lower. And then all you need to do is look for one move in the scope of Sunday's opening to Friday's close. Find one move that moves in that expected direction. The probabilities in a market that's bullish having a move that goes down to a fair value gap and runs relative equal highs or an old high, that is so monumental in terms of odds in your favor. It's unbelievable, but you not going to understand it. You're not going to believe it until you go into the charts yourself and see it. Back test it. Look and see if I'm talking out my ass. If you go into the charts and you look for these things with conviction, I'm going to go in there and I'm going to prove ICT wrong. Go in there and do it. Everybody that's ever done that, they're converted. Done. Because once you see it, you can't unsee it. It's there now. It's like riding a bike. So over those initial months, I started determining that I would get stopped out. And then I created what I was teaching back in 1996 and 97, shadow boxes. Okay, and what they were is where I thought stop loss orders would be, and they would run the stops. So they would run the stops and then go. So what I would do is I would wait for them to do a stop hunt. I didn't have the courage to go in and buy under the low, but I knew enough that it would go under them. And then once it did that, then I would use an hourly bullish divergence, type 1. And then I would get along on that, knowing that the backdrop behind the story, the narrative was they already went for the people for the stop hunt. So now my stop won't be hunted because they already did that work behind us. And that was what I was trading. Then eventually that morphed into when I got the book Street Smarts by Linda Rasch and Larry Connors. It gave me a little bit more confidence to go in, because I already knew enough that stop hunt, because I was a victim of them. Many accounts being dusted because of it. But the turtle soup pattern that they taught in that book, I don't trade that pattern, but the logic of it is what I use. When I say turtle soup, I'm paying homage to that book, those authors, those traders, and I'm not teaching theirs. I'm not reinventing it either. It was just the logic of buying below an old low or shorting above an old high. That book gave me the confidence to go in and start doing that. So when I tell you that book is noteworthy, it's because it had a tremendous impact on my understanding of price action and trading. It's scary to go into a chart and watch it really recklessly just drop suddenly right below an old low and view that as something you want to buy. That's a scary feeling when you've never done it before. It's hard to articulate it until you look at it and say, okay, I'm going to expect this to happen, and then try. It feels uncomfortable, and those are the trades that work. The most uncomfortable, alien-looking, most suspect-looking trades, they're the ones that work. The ones that you sit in front of your charts, you have no idea what the fuck you're doing. You're looking at it, you're thinking, well, I'm bored. You know, I'm going to just go in and just sell it here because it's been going up. It's got to go down now, and all of a sudden it goes up 150 pips more, right from when you got in at. And then how you feel. Yeah, I've done all that stuff before. I've done all that. I know exactly what you're talking about. I know what it feels like, okay? But all these early stages of my development, the lessons that I have gleaned from those painful events that were, at the time, feeling like impediments to my development, feeling like I couldn't get this figured out, and wanting to quit and stopping periodically. When I had these moments of, I can't do it, I've done blown another account, I can't do this, I can't do this. Well, I got a half right. I can't do it and be successful doing what I'm doing. So I had to change some. So obviously by chance meetings and things that I did on rec leverage that could have buried me easily, and making those calls publicly, and they were going parabolic, big moves happening and just unfolding in front of everybody's eyes.